What is behind Tesla's share price fade? Well, our chief equity strategist and economist, John Blank, says it all boils down to earnings fundamentals. John, you say that this can be best understood within the context of the Magnificent Seven stocks. How so?
Well, Terry, the other Mag 7 stocks have been posting very nice annual double-digit earnings. For example, Meta Platforms, while the stock went down today, was actually up year on year 27% in its earnings. And so Tesla, marking a negative volume quarter year on year was the distinctive element of its story because it used to do 40, 50% growth, and now it's over.
So are fundamentals showing intense price competition ramping up in the global EV markets?
Yeah, really, fundamentally, you got to understand that they put a giant factory in Shanghai, China, that was going to produce 1 million units a year, and basically taught the Chinese how to make electric vehicles. And they went out and Xiaomi and BYD actually make them much cheaper than Tesla, and they're actually apparently of the same size or even larger than the Model 3, and they sell for $11,000, $15,000, $16,000, Terry. So in that market, both CATL, the battery maker, which we must license this technology from, and a lot of these OEMs that are electric are simply not price competitive, or Tesla is not price competitive with them anymore.
What about other obstacles Tesla faces this month's delivery miss and layoffs, just to mention a couple? How do those factor in?
Well, they're trying to get their gross operating margin back up, and doing that by getting rid of a headcount that is in G&A positions and basically even line positions, and trying their best to keep their costs down. It's what they got to do when they get a negative volume year-on-year quarter versus the 40% growth they thought they were.
Speaking of earnings, the Q1 2024 earnings season is well underway. Investors are actually counting on a rise in S&P 500 quarterly earnings growth. Overall, are they going to get an increase, or are they going to be disappointed?
Well, Terry, I've got the numbers right here. Total earnings are now expected to be up 4.4% from last year, and that goes with 3.9% higher revenue. So let's keep the math simple and call it both revenue and earnings growth around 4% growth year on year. Add in about 2% for inflation, and you have a 2% real growth rate, which is largely inconsistent with the first quarter GDP numbers once you bake out a lot of one-time items like inventory adjustments and exports. So basically what we're learning here is, we're at trend growth in the U.S. economy after a long period of, post-COVID adjustment that looked a lot stronger. So now we're just kind of planing out into that long-term growth area.
What about robust corporate profits this year? Are they going to support rising stock valuations going forward, especially among tech sector companies, which just reported?
Well, the tech sector is certainly doing well, keeping the Mag 6 that are not Tesla in play. And the rest of the market is staggering along in a sideways motion along those long-term trends, more or less. So we need a lot, probably the third quarter, before we see some outline of what happens when things plane out.
Meantime, markets still keeping an eye on whether the Fed is going to hold off from cutting interest rates at all this year. New consensus in the market for easing is seen as September as a start date. How likely is that?
That's very likely still, Terry. I think, again, like I said, the third quarter is where I think we'll start to get some visibility, and September is basically the end of that quarter. So that's my view. I think a lot of people's view now is, we got 6 months before we can, or 5 months or 4 months before we can start to get a read on what happens when the economy planes.
What would it do to stocks in the event that they don't keep that timeline?
It depends on what happens with the trader consensus and the Fed dot plots, Terry, and those come out, every couple months, and that will determine whether the market likes it or not, because that will determine the level of the 10-year. 10-year got to 5%. We're now at about 4.7. So at this point, the market's still counting on some cutting. That's the 30 basis points from the 5. And that's what we got to keep watching for, is what the market keeps thinking. But right now, it's still betting on some cutting.
On the flip side, European central bank rate cuts are predicted to start in June. Do recently released European bank earnings support that timing?
I think so. I mean, you got to remember, even in like a place like Switzerland, basically has statutory inflation. It has cut rates already. Some parts of Latin America have been cutting rates for quite some time, and the European Union does not have extra strong growth and price inflation pressures from it the way the U.S. does. And that really sets a scenario up for them to cut rates earlier. I mean, it might not be a lot earlier, 3 months earlier, but they might move earlier.
All right, Zach's strong buy stocks this month include Prosus, Wells Fargo, and Uber Technologies.
Yeah, Prosus is a fascinating company. It trades really cheaply. It's in Europe, and it used to own and still does own. It owned a lot of Tencent, but now owns less of it. But it's kind of a roll up of a lot of different tech stocks. So if you want a European play, that is one. Wells Fargo Corporation, of course, WFC is a well-known bank in the United States. They just got released from a lot of oversight by the Federal Reserve for things that they had done in the past under a prior CEO and prior management. So that stock's getting a good look now, getting some upside to its earnings along with a lot of the other banks. And the final one is Uber. Uber, surprisingly, is doing quite well. I mean, everybody's been talking about robo-taxis, but at the end of the day, robo-taxis are well over the horizon. And what's happening right now is Uber, and Uber's doing pretty well.
Our chief equity strategist and economist, John Blank, on rate cuts and Q1 2024 earnings. With John, I'm Terry Ruffalo.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.